everyone for joining the webinar. We have a couple of things to talk to you about today. The first is a tax update. We're going to just give you just a bit of a flavor of what's going on as we prepare for the 2024 tax filing season, and introduce you to Sylvia Ho, who is a landlord consultant. And what she has been doing is she has been helping save a lot of taxpayers' money, especially those who've got a fairly good real estate portfolio or aiming to grow their real estate portfolio. And she's been doing that for, is it a couple of years now, Sylvia? You're muted.
I am muted. Hi, everyone. You think everybody's used to Zoom by now, eh? Mute, unmute, mute, unmute. So I have been a mortgage agent for the last 24 years, and in the last 5-6 years, I've specialized in working specifically with aspiring landlords and landlords.
Good. So what we're going to do is the agenda for today is essentially go through some of the recent tax changes and kind of helping everyone prepare for their documents. And then Sylvia is going to run through her presentation on and a few examples on how we can save some money going forward.
Great. So it's going to be about 45 minutes. And let me share your screen here. Give me 2 seconds. So does everyone see the screen here? I think so. Ali, how is it on your end?
Yeah, it's good.
Yeah, we can see it, Sylvia. We can see it.
Perfect. Okay,
Thank
go
you.
ahead, Ali.
Okay, so let's go to the first slide there. So the first thing I want to introduce is, as many of you know, is we've introduced a secure portal. And the purpose of the portal is twofold. One is you want to make sure all your documents are secure and confidential as they come in. And more importantly, it just allows you to organize the slips into a folder. So if you've got a way of organizing at your end, it's very seamless. You just select all of the items and then drop them into our folder. Now, some people are still in the old-fashioned way where they like paper. We scan everything. We're completely paperless now, so we don't have any paper in our office. We might print a few things for analysis purposes, but generally we try and keep everything as clean and paperless as possible. So CRA has really enhanced their way of allowing us to download items from your particular CRA account. Things like your RSP slips, your T3s, T4s, T5s. So if by chance you don't get any of your documents, we have access to your CRA account and can download all of these slips from the account and then put them into our portal and in our tax software. Tax installments, many of you have been probably receiving notices if you are in a situation where your 2023 tax payable was greater than 3,000 or more. You would get notices to make installments in 4 different time periods: March 15th, June 15th, September 15th, and December 15th. Now, some recent inquiries I'm getting is, but I haven't filed my 2024 taxes. How come I still have to make an installment for March and June? It's because CRA doesn't know what your numbers are. So my advice is just make those payments, and at least the first one, because by April 30th, your taxes will be completed, and then they'll give you a new set of installment schedules. And remember, this only applies to people who are in a situation where they have $3,000 of installments or more, or tax payable or more. Our contributions coming up early next week. So remember, the rule is 18% of your income. And when you say income, that's earned income. Dividend income is not qualified as earned income. It's only T4 income or self-employment or partnership income is considered earned income. The maximum limit is $31,560. They face a contribution, so they've increased it to $7,000. If you haven't contributed since they introduced this in 2009, you're able to do a lump sum of $95,000. And again, the benefit of the TFSA account is although you don't get an immediate tax benefit or deduction, it allows you to grow your portfolio essentially tax-free over that period. An example is, let's say you invested in 2009, and that's a period of about 15 years. Money generally doubles every 7 years. Your 95,000 portfolio, or not 95, but if you had a limit at that time, time value of money every year is about 7,000, you would have at least doubled your portfolio, and that income would be essentially tax-free when you draw it out. Investment expenses, a common misconception is I've got an RSP account. I've made a payment to my investment advisor, whether it be 1%, 1.25, 1.5%. Can I deduct it? The answer is no. You can only deduct investment fees for non-registered accounts. And TFSA is considered, in their eyes, a registered account. So the only ones you can do is if you've got an open account and paid investment fees, such as management fees, or sometimes the term MER is out there. Nowadays, a lot of the advisors will actually give you the breakdown of how much that amount is on their statements. So we can then deduct that directly from your tax return as a carrying charge. First-time home buyers account that was introduced about a year and a half ago. And you're able to, if you're a first-time home buyer, you can contribute $8,000 towards your new home. And essentially a lifetime limit of 40,000, and you get a deduction out of it, and it allows a lot of the younger generation who can't afford a home to have a new savings vehicle to afford a home in the future. Multi-generation home renovation tax credit, another one that people really don't know too much about. Essentially, you're able to claim up to $50,000. So if you've done a major renovation and you've done that to accommodate a few generations in the home, you're able to claim $50,000, and that'll give you a fairly large tax credit of 15% of that, or $7,500. Registered Education Savings Plan. This is a very important one, whereby the government matches a 20% grant for a $2,500 contribution. So essentially, you're getting $3,000 for the price of $2,500, and that grows tax on a tax deferred basis until the child is attending post-secondary education. The beauty of it is that, let's say you've accumulated $100,000 and your contribution is only $30,000. That's $70,000 that has grown over time, including the grant. Will be when the drawings are made, it's a T3 or a T5 in the actual child's name. So you're essentially taking advantage of growing money on a tax deferred basis, and it'll only be taxed under the child's name when they actually pay for a university or college education. Registered disability savings plans, again, you have to be eligible for the disability tax credit in order to qualify. And there are government contributions available in terms of grants in the amounts of $3,500 and $1,000 per year of eligibility. Again, there's a whole application process similar to the disability tax credit for those who have anybody in the family who is disabled. UHT returns, again, this is an evolving process. They were quite strict about a year and a half ago. The CRA has relaxed the rules slightly. However, there are still requirements, mainly for people who are non-residents, people who own property in a corporation, and foreign nationals. Bear Trust, this is the one that has the best news over the past year or so. Last year, everyone was scrambling to file the T3 return for anything that you were considered a trust. If you had a joint bank account with a family member, a joint property, you were considered to be in a Bear Trust type of a situation. This year, they've relaxed the rules on a lot of those. And unless specifically asked by CRA, you are not required to file a Bear Trust. Again, if you need more details on that, just contact me and I will look into your situation to see if you are required to file. Carbon rebates. So if you're a small business owner, what they have done is for the past 5 years, CRA has built up a carbon.
Ali, sorry, I muted you. Apologies.
That's okay. That's
Sorry.
okay. Carbon rebate is essentially something that started about 5 years ago, and they built up. They made it pretty much hush hush hush. But what they did is more from a political perspective. They've given small businesses a huge rebate. I've had clients who've got upwards of $30,000 to $40,000 of a rebate, depending on the number of staff that they've had over the past 5 years. The rollout started in December, and we're still getting a few of our clients that are getting rebates. Maximum amount of employees you can have in order to be eligible is 499.
Ali, I think that's it for.
Yep. So that's my update. I just want to kind of give everyone just some information in terms of what you need to gather as you prepare your tax documents. Obviously, everyone's in a different tax situation. Some people are self-employed, so there's different requirements. You've got rental property, there's different requirements. And speaking of rental property, this is a good segue to transition over to Sylvia, who will talk about cash damming.
Thank you very much, Ali. Hello, everybody. Okay, so we were having a little bit of tech issues at the beginning, so thank you for everybody who has joined us today. I'm going to talk about how to pay off your mortgage 8 to 12 years earlier than planned. And give me 2 seconds. Let me get this all set up here. Hiteshi, I can see that you're asking a question about interest deductibility. I'll definitely answer all questions at the end of the webinar. And then we'll go from there. All right, my friend? Okay. So, yeah, Mo. Ali, I'm going to make you co-host. So if you don't mind letting individuals in, that would be wonderful. Just press admit, and then that's it. Okay. So let's share my screen here. Okay, beautiful. So let me center this. Whoops. Okay, let's get started here. I think you can see the whole thing, right? Yeah? Okay, beautiful. Thank you very much. All right, thanks, Ali, for the intro. Thanks for having me here to chat with all of your clients. My name is Sylvia Ho, and I'm a financial landlord consultant. Today, I'm going to show you how to pay off your mortgage 8 to 12 years earlier than planned with an advanced financial strategy that is used by wealthy Canadian landlords. Today, I'm going to show you ways to legally pay less income taxes and redirect those savings to attain mortgage freedom, and thus cutting the interest that you pay the banks, so decreasing interest that you pay the banks. And since you're going to be mortgage free earlier because you applied this advanced financial strategy, you will redirect those mortgage payments that you already committed in doing, but you don't need to make a mortgage payment because you have no mortgage. You're going to redirect those mortgage payments towards your retirement. And the coolest part about this entire strategy that I'm going to be talking to you about is that you can gain all of these benefits that we're talking that I just showed you right now without bringing extra cash out of your pocket. Now, this is very, very rare, okay? Because most financial plans require that you bring out money in order to gain that benefit. For example, your financial planner will say, hey, you want to retire with more money? You got to bring out an extra $200 per month, save it for retirement, and then your retirement portfolio will grow, and then you can benefit from it in the future. But this specific strategy will not ask you for any extra cash. I'm not going to ask you to bring up more money from your savings account to make this all happen. I won't ask you to pick up a part-time job to make extra lump sum payments to pay off your mortgage. all I'm going to ask you to do is this. Make your regular mortgage payments on your owner-occupied home and collect rental income. So let's get started. All right, Canadians. Canadians are cash strapped, right? The reason we're cash strapped is because the government takes a majority of our money in the form of taxes. When we get paid, the government will take 40 to 50% right off the top. And then when that money goes into our bank account, where is the next part? The next part of the money, almost more money, goes to the mortgage, right? And then when we buy things, we have to pay taxes on those things that we buy. And then when we buy property, we pay land transfer taxes, right? Everyone agrees we pay land transfer taxes, right? And then now we have to pay taxes on something we already pay taxes on. Isn't that crazy? Taxes, right? So our money goes to taxes and it goes to mortgage payments. So, and then whatever is left over is what we use for our everyday living. So we, as Canadians, are making tough decisions. We're making tough decisions because we are focusing on today, which is our family, which is right in front of us. And what gets sacrificed is the money we put aside for our future savings. And when we all know that when we put off investing for the future, we lose out on those valuable years. We lose out on those valuable years where those investments can compound and grow. So bottom line is we need better strategies. We need better strategies to deal with the realities of today because taxes are not going down. Our incomes are not going to magically double overnight. Our cost of living is just going to keep going up, even though the government has been trying to control inflation. Bottom line is these pressures are not going away. With this advanced financial strategy, I'm going to ask you to keep an open mind. I'm going to ask you to look at this webinar as a mindset change in the way you think about your mortgage. Because your mortgage is, in fact, a powerful tool. Even though most people consider it a liability, it's actually a powerful tool. Your mortgage is an asset. And when you structure your mortgage properly, you will gain tax benefits, which will help you attain a path to financial freedom. Now, this concept was first started in the late 1980s by Fraser Smith, who wrote the best-selling book, Is Your Mortgage Tax Deductible, back in 2003, where he talks about the Smith maneuver and how he developed this financial technique in helping hundreds of families. Now, more recently, Robinson Smith, Fraser's son, wrote a follow-up book titled Master Your Mortgage for Financial Freedom, which provides a step-by-step process in making your mortgage tax deductible. And when you watch this webinar all the way to the end, I'm going to throw in a free copy right here to one lucky participant as a thank you for sticking around all the way to the end of the webinar. Now, today we're going to focus on the strategy called cash flow dam or rental cash damming, which is just one component of the Smith maneuver. And rental cash damming deals specifically with the process of optimizing your rental property cash flows, where I will teach you how to reallocate the way you use your rental income. Now, within the Smith maneuver, there are other wealth building techniques, but they go beyond the scope of this webinar today, so we won't be talking about them. We will have a Q&A at the end, so please put your questions into the chat box. And as we dive deeper, just a reminder, please turn off your cell phones, close your browsers, have no distractions, and even close the door so you can make the most of this webinar. Now, this is a good time to note that I am not a financial planner and I'm not a tax accountant. I'm a financial landlord consultant. I'm a landlord myself. I own 7 properties, and I'm a mortgage agent for the last 24 years. I specialize specifically in working with landlords to help them save money, reduce the taxes that they pay, and cut the interest that they pay the banks. And I'm also known as the cash damming queen. My vision for all of Canada is to have every single landlord apply this strategy because it's just so powerful. Now, this is how a majority of landlords run their business. They get their rental income, they deposit it into their bank account. And then from that bank account, they pay all of the rental expenses. And then if you're lucky enough to have positive cash flow, you'll have a small sum gather up in this account. And then at the end of the year, you will pay your income taxes. And if you're lucky enough again, you'll have enough money to take your family out for a small dinner, right? But if you are a landlord in negative cash flow, say $200 per month, what you're going to do is you're going to bring out $200 from your regular T4 income, put it into this account, and then you're going to say, that's okay. That's okay. I don't mind bringing out $200. I'm saving for the future. This is an investment for the future. It's worth it. But the problem about running your landlord business this way is you lose out on tax efficiencies. Now, typically my webinar is 1 hour long, but today I'm going to give you the Coles Note version of it. And I'm going to run through one case study. Now, if you would like a copy of my slides today, and you would like access to the full 1 hour training, where I actually go over the step-by-step process, the actual blueprint on how to do it, please put your email address in the chat box and I'll send it over to you. All right, so this is a wrong way in running your landlord business, but this is how 99% of landlords run their landlord business because that's just what we've been taught. Instead, what I'm going to ask you to do is do it this way. When you get your rental income from your landlord, from your tenant, when you get your rental income from your tenant, you're going to put it into a bank account. And then when it goes into this bank account, you are going to prepay your primary home mortgage. You're going to make a lump sum payment against your own home mortgage. So you're going to take, say, $3,000. You're going to pay down your owner-occupied home mortgage. Because when you get that $3,000, that rental income, when that money comes in, there's no rule that says you have to take that $3,000 to pay rental expenses. You can do whatever you want with it. CRA doesn't say you have to use that money to pay your rental expenses. So when you get that $3,000, you can go on vacation with it. You can take your grandkids on vacation. You can, I don't know, pay your credit card bills. You do not have to pay your rental expenses with that. So you're going to prepay your mortgage. And then what you're going to do is you are going to use your HELOC, your re-advanceable line of credit, to pay for all the rental expenses. And when you do it this way, you will get tax refunds from the government. Because the fundamental rule behind this strategy that's been tested since 2003 when Fraser Smith started this strategy is whenever you borrow money to invest with a reasonable expectation to earn income, you can deduct the interest costs. Let me say that one more time. The fundamental rule behind the Smith maneuver is that whenever you borrow to invest and there is a reasonable expectation to earn income, you can deduct the interest costs. And that's it, my friends. That's how simple rental cash damming is. Now, keep in mind, I literally went over rental cash damming in 3 minutes, and typically my webinar is 1 hour. So if you would like access to the 1 hour training that goes through the step-by-step process and the blueprint, put your email address in the chat box. I see some people putting it in there right now, and then I will make sure you get a copy of the training and today's webinar. All right. So that's how you do rental cash damming. You take the money, you prepay your mortgage, you use your re-advanceable line of credit to pay for all the rental expenses, you deduct the interest costs with Ali, and then you get a tax refund. And thanks to the efficiency of this plan, the homeowner is able to make some serious headway on their wealth improvement without affecting their personal cash flow or their lifestyle. Next, I'm going to go over a case study and the benefits of rental cash damming. Now, before I show you the numbers, because Sylvia loves numbers, let me tell you the backstory behind this client. So this client wanted to pay off their mortgage on their owner-occupied home sooner. And because they were in negative cash flow, they're like, why don't we just sell our rental property? But the problem about selling rental properties is, one, Sylvia says, don't sell your rental properties, right? But don't sell your rental properties. And they didn't want to sell. Well, they were thinking of selling it, but they didn't sell because they would end up paying 6 digits in capital gains, which they did not want to pay. So this accountant referred them to me, and these are their numbers. Okay. So they had a mortgage of $580,000. They were making mortgage payments of $3,400 a month. They also had car loans, 2 car loans, $40,000, and they're paying $650. So their total family expenses for their mortgage and their car loan on their primary home, on their owner-occupied home, is $4,000 bucks. They're also landlords, and they're receiving rental income of $2,500 per month. But because of the increase in rental expenses, they were in negative cash flow of $272. So let me see if I can turn on my laser pointer. Okay, yeah, so here are their total expenses. And this is a rental income. The rental expenses are more, so they're in negative cash flow by $272. So for this particular family, the total family budget was $4,050 plus $272. Total family budget is $4,322 per month. Now for this family, they were on a 27-year amortization, meaning that $580,000 will take them 27 years to pay off the mortgage. But because they applied the strategy of rental cash damming, they will now pay off their mortgage instead of 27 years in 17.75 years. Almost 10 years off of their mortgage. They're going to be saving over $500,000. And all this will occur for this client because they applied the strategy. And the beauty about all this, it's the exact same budget. They make their mortgage payments and they collect rent. Now, as a financial landlord consultant, the first step that I will do is I will do a mortgage and cash flow audit. So what does a cash flow audit and mortgage audit look like? Well, I'm going to look at their numbers. And these are the 2 red flags that appear for me. The car loan for $650. In my opinion, car loans are wealth killers. They kill your ability to build wealth. And the second thing is a negative cash flow on the rental property. So the first thing that we're going to do in this mortgage and cash flow audit is I'm going to recommend that they do a debt consolidation. I'm going to recommend that they take their $580,000 and their $40,000 car loan and they combine it into one mortgage for $620 to free up that $650 per month. The second thing I'm going to recommend is to refinance their rental property back to a 30-year amortization. By doing this, it lowers their monthly mortgage payments. It gives them better tax advantages. So now here are what the new numbers will look like. They have no more car loan payments. Their mortgage payment is now $3,480. The new mortgage payment on the rental is $1,683. So the total family budget is $3,613, which means they're saving an extra $700 per month. Question for you. What would you all do with an extra $700 per month? Please put it in the chat box. Let me know that you guys are still with me. What would you do with an extra $700 per month? I'm going to wait for a few responses before I keep going. So tell me, what would you do with an extra $700? Prepay, okay? Yeah, like that. Anybody else? Invest. Good. What else? I need at least five answers. Invest. Pay down debt. Okay, Mo, good. One more. What would you do with an extra $700? Lease another car. You're funny, buddy. Paid on credit card expenses. Awesome. Credit card expenses. That is like a car loan. It's a wealth killer. So we're going to do debt consolidations. Now, I'm surprised no one said go on vacation. I love going on vacation. $700 a month, I'd go on vacation. Come on, everybody. Somebody put down vacation there, please. All right. So what would you do with an extra $700? Thank you. Extra $700 per month. So this is what would happen. when it comes to financial strategy, step number 2 is to come up with an advanced plan. Okay. And this particular family applied the strategy of rental cash damming. Now, there's a lot of numbers here, so I'm going to go over each one. Because they applied the strategy of rental cash damming and they used their line of credit to pay for the rental expenses, they're going to get $112,000 in tax refunds. And then what we do is we take the $112,000 in tax refunds, and we're going to reapply that towards, we're going to reinvest that towards their mortgage. And by reinvesting that tax refund into their mortgage, they will go from 27 years to 17.75 years. And again, all this with the exact same cash flow. And because they don't have to make mortgage payments from 17.75 to 27 years, they're going to redirect those mortgage payments towards retirement. And they're going to save $511,000, and they're going to invest that money, $500,000. That's the mortgage payments that they saved from 17.75 to 27 years. And that $511,000 at 8% growth will grow to $863,000. And that's it, my friends. That's it. That's how we, by applying this strategy, that's how we pay less income taxes. We redirect those the tax savings to our mortgage, and then we pay less interest to the banks. Oh, we have somebody who's not muted here. We pay less interest to the banks, and we now, because we paid off our mortgage earlier, we could redirect those mortgage payments towards saving for retirement. And so we are ahead of the game. We can have our cake and eat it too. So if you're interested in a cash flow audit and a mortgage audit, the next steps would be to book a time with me. So I am going to, you can scan this, but I'm also going to put in the chat box my link to book a time with me. And that's it, my friends. That's the end of the webinar. So thank you so much for joining with me today and Ali and staying all the way to the end. Book a call with me, scan the QR code, you'll get all of my information, and then you can save it onto your phone. And what we'll do is we will have an open mic Q&A session on any questions that you may have. And we're going to also do our book giveaway.
Sylvia, can I make one comment?
Yeah, go ahead.
Yeah, so basically, this is basically vetted through CRA. When Sylvia and I first started to talk about this, I actually questioned her and I challenged her and I said, we need to figure this out because we can't, everybody knows me, I will not take any risks in terms of trying to compromise your tax situation. So there is a folio, and Sylvia, maybe, I don't know if you can send that to everybody or so that way they can do some reading on it.
Yep, absolutely. So I'll put it into the chat. So this is the folio. This is the interest deductibility folio that talks about this whole strategy. And this is the, I already have the book. That's awesome at the time. So this is the link, and this is where CRA says this is how you do it and how you can do it. So this strategy is CRA approved. They vetted it over 20 years ago when Fraser Smith first started this. And yeah, I think that is it. So let's see who is gonna win this book. I'm gonna get the names in. Give me 2 seconds. Okay, do we have any questions in here? And Ali, maybe you can pick a winner. Ali, do you mind just picking a winner while I answer these questions? Just do randomness. Okay. Hitachi, is interest paid on the primary residence mortgage tax deductible? Good question. So the interest on your principal residence, if you are living there, it is not tax deductible. And Ali can confirm that because you are not, that interest, you're not, it's for your own personal use. You're not investing it to go make more money. So that's good. Okay, so I got a bunch of emails here. So if you want to copy today's webinar and the training to the 1-hour training that goes over the step-by-step process, put your email address in the chat box and then I'll send that over to you.
Sylvia,
Can you pick the winner?
Oh, yeah, absolutely.
Go ahead, Ollie.
No, sorry. No, you go ahead.
We have a mortgage, but it's on a rental income. Does this strategy still apply to that?
Do you want me to answer that?
Yeah, go ahead.
Okay,
It does, but you can expand on it.
Okay, yeah. So let me ask you a few quick questions. So are you talking about the mortgage on your rental property?
Correct.
Okay, so the mortgage, the interest on your rental property is always a tax write-off.
Right.
Okay? The interest on your owner-occupied home is not a tax write-off because you live there.
Right. So I'm interested in applying the strategy that you're just talking to our rental, to the mortgage that we have for the rental property. Can that be applied?
So this whole strategy is
Yes.
to get rid of the debt against your owner-occupied home. Do you have a mortgage against your owner-occupied home?
No.
No. Okay. So then you have maxed out your tax efficiency. Okay. So the next step I would tell you is don't try to pay down the mortgage on your rental property. Try to eat up as much of that rental income for your own personal use and maximize out the interest. Don't, like, a big mistake that I see. Yeah. Sorry, go ahead.
Yeah, no, what I was going to say is, however, that's a good problem to have, Paul and Adriana. So what you can do is you can essentially still use a cash damning strategy and use the savings for anything else.
Mm-hmm. Yep.
Right. And a good one would be TFSA. Just max out your TFSAs.
Okay. Thank you.
Put the rental income into your TFSAs. Yes, you can do that. Yes, you're right. Okay.
Or anything else, go on a vacation.
Yes. Yes, absolutely. Okay. We have Hitesh here. Oh, Ali, I'll let you do that. Can we use RCL instead of a HELOC since we might not have HELOC available? What is RCL? Is that like, Hitachi, are you still here?
Oh, credit line. Yeah, it's the same thing.
Yeah, is that registered credit line? I'm assuming, I think you mean, okay. So when it comes to rental cash damming, the number one thing about it, and you'll learn this in my 1-hour training, is that it has to be a re-advanceable line of credit. It cannot be a line of credit in second position. It cannot be a unsecured line of credit because then you're going to run into issues. Okay, so Hiteshi, we can chat offline if you'd like about your specific scenario. Book a call with me. It doesn't cost anything to have a 20-minute chat with me to run your scenarios and to do like a cash flow and mortgage audit. So click on the link to book a time and then we can chat more. But rental RCL, I'm assuming that is a re-advanceable credit line.
It's a revolving credit line, I think.
Yeah,
Revolving.
okay, revolving, is that what they mean? Okay, yeah, so revolving, re-advanceable, yes, you can. Prepay, invest, pay down. I think someone's vacation, thank you. How? I'm not sure what page is. Thank you, Sylvia. I already have the book. Okay, so Anand, Siptan, I'll get to you in a sec if you wanted to put your question in the chat box, but I'll get to you once I finish this list here. Does this strategy, what are we doing? It's the other Ali. Does this strategy work for landlords with negative cash flow who have investment properties in real estate holdcos and collect rent through real estate management companies? Okay, so no, this strategy does not work. Okay, I muted him. So this strategy does not work for properties in holdcos and management companies. That does not work. The rental property must be in your personal names, and the owner-occupied home must be in your personal names. Okay, so you cannot do this if the rental property is in a holdco, because by having a rental property in a holdco, you already have tax benefits. So CRA doesn't allow you to double dip. Can we use, oh, here we go again. Readvanceable credit line instead of HELOC as no property is yet having more than 20% equity. Hitachi, you'll have to like unmute in a sec. Quick question for the case study. Where did the car payment debt get consolidated to? Oh, yeah. So Shugs, that's a great question. Oh. Okay, well, I'm going to answer it anyways. So the car loan, the mortgage was $580,000. The car loan was $40,000. We combined them into one mortgage of $620,000. So we did a debt consolidation. So I hope
Got it. Thank you.
Yeah.
And the purpose of that, Shagufa, is essentially what you're trying to do is you're trying to reduce your monthly payments. And that's part of the whole cash damming strategy.
That's perfect. Thank you. I was trying to figure out how it got consolidated into the first mortgage or into the second one. So that's understood.
First mortgage and second mortgage. Yeah. So
There was the rental mortgage and then there was the primary or the other residence mortgage. So I just was trying to figure out where you would consolidate that debt to with your expertise.
Yep. So you would consolidate it with your personal mortgage, not your rental.
Perfect.
Unsecured revolving line of credit. So nope, you cannot use an unsecured revolving credit line because you will run into so many roadblocks and it will not work.
And the link that Sylvia has sent clearly mentions that there's got to be a property that's secured.
Okay. How do you pay off the credit line? Yeah, great question. So there are two phases when it comes to rental cash damming. The first phase is where you convert bad debt to good debt, and you'll learn this in my webinar, in my training. The bad debt is the mortgage that's against your owner-occupied home. Because the reason we say that's bad debt is because that interest on that mortgage is not tax deductible because you live in it. Okay. And then what we do is we take the rental income, we pay that down, and then now we use the line of credit to pay for the rental expenses. As long as there's a clear cash flow audit of how you're doing this and why you're borrowing the line of credit for the rental expenses, you can deduct the interest costs. That's phase one, is to get rid of your bad debts. In that example, it was the 580 plus 40 to get rid of that $620,000. The second phase of rental cash damming is to now get rid of the line of credit.
Sylvia, follow-up question to that, Ali here. If you're taking out money from the line of credit, then you're paying interest on that.
Yeah.
But you're writing off the interest, but you're still paying more than what the rental expense would have cost to begin with.
So are you talking about the interest payments on the LOC?
On the LOC, yes.
Yep, absolutely. So as you use money, as you take money from the line of credit and you pay the rental expenses, this line of credit is going to keep increasing.
Correct.
And every single month, there are payments that need to be made on this line of credit.
Yes.
So as a financial landlord consultant, I work together to show you how to make those payments.
Okay. Okay.
You had a number of $112,000 savings. What is this savings from? Where did you see 112? Oh, that's the tax savings. Okay. So when you use your line of credit to pay for the rental expenses, you can write off the interest costs on that line of credit. Over the strategy for this particular client, this strategy was 17.75 years. Over that 17.75 years, you could deduct those interest costs. And by deducting those interest costs with Ali, when you do your tax returns every single year, you're going to get back tax refund in the form of $112,000. And this is for someone at a 50% tax bracket.
So this is a cumulative number, right? I think maybe that's
correct.
What
Yes,
is
this
asking.
$112,000 is a cumulative over the 17.75 years. Yeah, it's not one lump sum payment of $112,000 because, hey, everybody would be doing that today, right? They'd be like, where'd you get that check from? I want one in my name. Yeah. So this $112,000, those tax refunds are small at the beginning because you only borrowed like X amount of dollars, right? The line of credit. But as the line of credit gets bigger and bigger and bigger, your interest costs get more. You could deduct this interest cost and you'll get back, in this sense, 50% tax bracket. Where is the savings from? Is this the Smith maneuver? Yes, this is absolutely the Smith maneuver. I'm Smith maneuver certified. This is the cash flow dam. CRA calls it rental cash damming. That's it. Sitan, oh, you put your question into the chat box. Does anybody else
I
have any?
did have a follow-up as well.
Go ahead.
So you mentioned you can't use this if you have your property in a corporation.
Mhm.
You cannot. But like, for example, if I'm paying down my personal mortgage and I'm using a line of credit to loan it to my corporation, it would be a similar effect, right?
That's an Ali question. I like to stay in my lane, my friend.
No. So basically, you can. I think interest deductibility is still possible through the corporation. It's just that the efficiency of the actual cash damming strategy won't work through a corporation. So you're absolutely right, Septen. You can still claim the interest off of any debt that you have through a corporation. And so it is possible.
Right. Got it. Thank you.
Yeah, so I would redirect that question towards Ali. Ali will be able to answer that. I always like to stay on my lane, which is about mortgages and about cash damming and financial strategies. And very it's very specific how we have to do this.
And sorry, Sylvia, I joined a little bit late, unfortunately, but are you also a mortgage broker? Like if we have a renewal coming up?
Yep.
Okay.
So I'm a mortgage broker. I've been a mortgage broker for 24 years. I subspecialize in working solely with landlords and aspiring landlords to help them apply the strategy to retire with more money and retire with the life that you want.
Okay. And do you work with single family homes mainly and condos, or do you work with commercial properties as well?
No,
like multifamily? No.
Well, see, the thing is that if this multifamily was not incorporated, which most of them are, then yeah, sure, we can do this, right? So I have some families that have, I have I have a client who has 2 sixplexes out in Nova Scotia. They're in his personal names. So yes, we can apply. So multifamily, we can apply. But if somebody came to me and they say, hey, we have it in a corporation, then no, you can't do that because you can't double dip. CRA won't allow you to do that. Yeah. And when I work with clients, I'm very, very clear and very, very particular about which clients I pick up because I want this product to work perfectly for them. Okay. So if I don't have a personal mortgage and only have a property with a mortgage, which I am renting and it generates income for me, I can say I have good debt. Yes, you are correct. So if you don't have a mortgage against your owner-occupied home, right? So you got rid of all of your bad debt and you have a rental property that has a mortgage on it, then yes, you have already converted all of your bad debt to, you have no debt at all. So that's good. So where you can apply the strategy is you can take the rental income, you can go invest it, and then you can do cash damming if you want. But
Sylvia, can I ask one question? I'm sure this has crossed a lot of people's minds. With a decreasing interest rate environment that we're in right now, is that a good thing or a bad thing when it comes to cash damming?
Well, yes, absolutely. It comes down to, do you have a mortgage against your owner-occupied home? Right? Because the whole idea behind this is how to pay off your mortgage 8 to 12 years earlier than planned. Right? So if you have a mortgage against your owner-occupied home and you're paying interest on this bad debt, it absolutely makes sense. And that's what I do when I have that initial consultation call and I do a cash flow and mortgage when I do a mortgage and cash flow audit, right? We will look at the numbers. And if it doesn't make sense, I'll tell you if it doesn't make sense.
Good.
Yeah. All right. Oh yeah, so we have the winner here. So I put the winner here. Give me 2 seconds. And oh, is this person still here? Anand. Is Anand here? Yes, I think Anand is here. Anand's right here.
Yes. Yes.
Did you say you had the book already? Or was that someone else? Dad,
Sorry.
you're the winner.
Hi, Anand.
Hi.
You're the winner, Anand.
Thank you. So how big is the book?
How big is the book? Why is it? It's this much. Is that okay? Will you read it?
Of course. I will.
Oh, Okay.
You
All
know,
right.
even whether I benefit or not, maybe my kids could, I can pass that strategy to my kids.
Yeah, absolutely. Okay, so Anand, if you can please get me your mailing address, you can just reply back to the emails that I sent out on the email, the confirmation, and then I'll get that mailed out to you. And that's the end of the webinar, my friends. If you have any other questions, right now is a good time. Unmute yourself in chat, and then we're just going to wait for everyone to go out, and then we'll close down the Zoom.
Thank you, everyone, for attending.
Great. Thank you so much, everybody.